Hey everyone, welcome back to We Are Cosmic, the place where we break down the world of cryptocurrency in a way that's easy to understand. If you're new here, I'm your host, and I analyze crypto markets, trends, and big moves by institutions so you don't have to get lost in confusing charts or technical jargon. Today, we're diving deep into some insights from Charles Hoskinson, the founder of Cardano, about what financial institutions are trying to do in the crypto space. And trust me, it's not all good news. So let's set the stage. Imagine the last 5 years in crypto. We've seen the rise and fall of NFTs, the collapse of projects like Luna and FTX, memcoin crazes, and political events shaking the markets. Every time retail investors were hoping for a magic fix, a MacGuffin, as Hoskinson calls it. A MacGuffin is basically a magical solution people think will solve everything in a few months. We've had many MacGuffins, regulatory promises, big companies entering crypto, and hype around new protocols. But often, when we got there, it was like arriving at a closed hotel. Promises were made, but results were lacking. This feeling of frustration is real. Many investors are tired, and there's a sense of hopelessness in the community. But this is exactly why understanding what's happening behind the scenes is so important. Hoskinson warns that institutions, big players like Goldman Sachs, JP Morgan, and BlackRock are consolidating power in crypto. They want to move everyone from non-custodial wallets, where you hold your own funds, into custodial systems they control. Their goal? Restrict DeFi and control a large portion of the industry. For anyone who believed in decentralized finance and pushing financial power to the edges, this is a wake-up call. But here's the important part. Despite all the challenges, there's still hope. We need new technology, new narratives, and new strategies to keep the decentralized vision alive. Crypto isn't dead. It's evolving. Hoskinson talks about the importance of building solutions that are interoperable across ecosystems. This means that instead of asking users to leave one blockchain for another, new projects should integrate seamlessly with existing networks like Ethereum, Solana, Cardano, and XRP. The key takeaway? Usability and network effects matter more than hype. Another point Hoskinson makes is about the mental toll the crypto market takes. Social media, especially platforms like Twitter, can feel overwhelming and negative. That's where channels like We Are Cosmic come in. Here, we focus on clear, concise, and meaningful updates so you don't get lost in the noise. It's about understanding the bigger picture and staying informed without burning out. To wrap up this opening section, think of today as a deep dive into the real forces shaping crypto. We're going to analyze how institutions are influencing the market, what Cardano and other ecosystems are doing to stay relevant, and how this affects you as an investor. Whether you're a retail trader or a long-term holder, knowing the strategies, pitfalls, and opportunities is essential. So take a deep breath, strap in, and let's get ready to explore the next phase of crypto, where the stakes are high, the moves are strategic, and understanding what's happening behind the headlines can give you a serious edge. In the next part, we'll break down exactly what these institutions are planning, the implications for decentralized finance, and why OG crypto investors are feeling both frustrated and motivated to fight for the vision Satoshi imagined. All right, in this part, let's get into something that really matters for anyone involved in crypto, the role of big institutions and how they're reshaping the landscape. Charles Hoskinson, the founder of Cardano, warns that large financial players like Goldman Sachs, JP Morgan, and BlackRock are starting to federate the crypto industry. In simple words, they're trying to take control of large parts of the market, and this could change how decentralized finance, or DeFi, works for all of us. Right now, many crypto users hold assets in non-custodial wallets. These are wallets where you, and only you, control your private keys. Non-custodial wallets are the heart of true crypto freedom because they put financial power in the hands of the user. On the other hand, custodial wallets are controlled by companies. When your crypto is in a custodial wallet, the company technically holds your funds, and you have to trust them to secure your assets. Hoskinson highlights that institutions want to push everyone into custodial systems. Why? It gives them more control over the ecosystem, including the ability to influence DeFi protocols, transactions, and even regulations. This trend is worrying because it could limit innovation. DeFi, in its purest form, allows people to borrow, lend, trade, and earn interest without intermediaries. If institutions control most of the market, non-custodial wallets could be restricted, and new projects could be heavily regulated or even banned. Essentially, the industry could consolidate into 10 to 15 big actors, losing the decentralized nature that made crypto revolutionary. OG investors who joined for financial freedom and decentralization feel frustrated because the original vision could be hijacked by corporate power. Hoskinson points out that some apathy exists in the community because institutions are making forward progress. The frustration is understandable. After years of hype cycles, NFTs, meme coins, and collapses like Luna and FTX, retail investors are tired of promises. Yet there's also a rallying point here. Understanding this shift is the first step in protecting your investments and staying ahead. We need new narratives, technologies, and strategies that reinforce decentralized finance instead of letting it be co-opted by corporate interests. A critical lesson here is about network effects and interoperability. Many new blockchain projects fail because they demand users migrate from existing networks. Hoskinson stresses that successful crypto ecosystems integrate with the ones people already use, like Ethereum, Solana, Cardano, and XRP, rather than forcing users to abandon their existing wallets or assets. This is especially important for projects that aim to offer privacy, smart contract functionality, or other advanced features. By building solutions that work across chains, developers can maintain growth without alienating their user base. Additionally, there's a psychological angle. Constant market downturns, social media negativity, and regulatory uncertainty have mental effects on investors. Hoskinson notes that platforms like Twitter amplify frustration with people constantly debating losses and failures. Channels like We Are Cosmic exist to give you a clearer, calmer perspective, focusing on real opportunities, market trends, and strategic analysis. This mental clarity is crucial for making smart decisions in a volatile environment. To sum up, the rise of institutional control is a major factor in crypto's current challenges. Understanding the difference between custodial and non-custodial wallets, the risks to DeFi, and the importance of interoperability across blockchains can help you stay informed and prepared. While frustration and fatigue are natural, knowledge is your weapon. By staying aware of how institutions operate and what the market's underlying trends are, you're better positioned to navigate the next phase of crypto evolution. In the next part, we'll explore specific strategies like airdrops, ecosystem integration, and layer zero partnerships. We'll also see how Charles Hoskinson is planning to attract new users while keeping decentralization alive. Now that we've talked about institutions and custodial control, let's shift to something more actionable and exciting for crypto investors: how projects grow, attract users, and build networks without losing what makes crypto special. One of the key strategies that Charles Hoskinson mentions is airdrops and interoperability across blockchain ecosystems. So what is an airdrop? Simply put, it's when a project distributes free tokens to users, often to reward early adopters, encourage engagement, or expand awareness. Hoskinson shared a real example: Midnight, a privacy-focused project, airdrop tokens across 7 to 8 blockchain ecosystems, including Solana, Ethereum, Bitcoin, Cardano, and XRP. About 33 million people were eligible, and around 1 million actually claimed the tokens. The goal wasn't just giving free coins, it was integration and accessibility. People didn't have to move their assets from one blockchain to another to participate. They could use tokens within ecosystems they already belong to. This kind of approach respects network effects and keeps users engaged without friction. Why is this important? Many blockchain projects fail because they force users to migrate. They say, move all your assets here, use our chain exclusively, or you miss out. But most users don't want to abandon Ethereum, Solana, or Cardano. They've built communities, invested in wallets, and rely on those networks. Hoskinson points out that successful projects focus on abstraction, making technology simple and universal. If users can continue using their existing assets while accessing new features, adoption grows faster. It's like layering new benefits on top of what people already have, rather than asking them to start over. Another lesson here is about real-world application and engagement. Airdrops aren't just free giveaways. They're experiments in building ecosystems and introducing new functionality. Midnight allowed users to access privacy-enhancing features with tokens they already owned. By doing so, the project demonstrated a path for innovation without disruption. This also ties back to Hoskinson's broader philosophy. Crypto projects must balance utility, governance, and adoption to succeed long-term. Interoperability is equally critical. Think of blockchain ecosystems as different cities connected by bridges. Projects like Cardano, Ethereum, and XRP all have unique features. If users can move seamlessly between these cities without friction, the entire industry grows. This is why Layer 0 partnerships are so important. They allow cross-chain collaboration and bring together separate ecosystems into a more unified network. Hoskinson emphasizes that these integrations are not just technical, they represent strategic growth by combining communities, users, and value. Airdrops and interoperability also provide a morale boost to the crypto community. After years of market turbulence, NFT crashes, memecoin hype, and regulatory uncertainty, investors often feel burnt out. Seeing projects successfully integrate multiple chains and reward their users gives hope. It's a reminder that crypto innovation is still happening and opportunities exist even in difficult markets. Finally, there's a big lesson here for you as an investor. Don't chase hype alone. Look for projects that focus on user experience, ecosystem integration, and long-term adoption, rather than just marketing campaigns. Projects that prioritize interoperability and user accessibility are more likely to survive market downturns and benefit from future growth. In short, airdrops, abstraction, and interoperability are not just technical strategies, they are foundational approaches to building sustainable crypto ecosystems. They show that innovation is not about forcing people to switch chains, but about enhancing their current experience, growing communities, and expanding real-world adoption. Now that we've covered airdrops and interoperability, let's dive into some major developments in the Cardano ecosystem and why they matter for the broader crypto market. Charles Hoskinson recently announced exciting updates, including partnerships with Layer 0 and the integration of USDCX on Cardano. These are not just technical achievements, they're strategic moves that could reshape the way investors and institutions interact with blockchain ecosystems. First, let's talk about Layer 0. This partnership is designed to enable cross-chain communication. In simple terms, it's like building bridges between different blockchains, allowing assets and data to move seamlessly. For investors, this is huge because it increases usability and reduces friction. Instead of being locked into a single blockchain, users can interact with multiple ecosystems, Ethereum, Solana, Cardano, XRP, and more, without losing access to their assets. Layer 0 essentially creates a unified crypto experience, which is essential for adoption and network growth. Next, we have the USDCX integration. USDC is one of the most widely used stablecoins in crypto. By bringing it to Cardano, users can now transfer value instantly between Cardano wallets like Lace and major exchanges such as Coinbase or Binance. The integration isn't just fast, it's private, immutable, and irreversible, which gives it an edge over traditional financial transfers. Imagine sending money globally in seconds, with privacy protections baked in and without relying on banks. This is a real-world example of how blockchain is starting to outperform traditional finance. Hoskinson emphasizes that these developments are not just for tech enthusiasts. They're designed to attract new users and institutions. Layer 0 and USDC integration make Cardano more appealing for DeFi applications, real-world assets, and even institutional adoption. When institutions see that a blockchain can handle transactions securely, efficiently, and across ecosystems, they're more likely to participate. This creates a positive feedback loop. More users and institutions increase liquidity, which attracts even more projects and investors. But there's a deeper lesson here for retail investors. Many people think projects like Cardano or XRP are dead when prices are stagnant or social media is quiet. Hoskinson argues the opposite. Real innovation is happening behind the scenes. Partnerships, integrations, and cross-chain solutions are quietly building a more resilient ecosystem. Instead of chasing short-term price movements, long-term investors should watch for these structural developments. They're what create real value over time. Another important aspect is interoperability with DeFi. Hoskinson mentions that XRP DeFi on Cardano could unlock massive potential. Over $140 billion in value could be utilized more effectively if smart contracts and cross-chain tools are applied. This highlights a critical trend. The next wave of crypto growth isn't about flashy tokens or memes. It's about real utility, adoption, and bridging networks. Finally, let's consider the broader market implications. Layer 0 and USDC integrations signal that blockchains are moving from niche experiments to viable global infrastructure. They're not just about speculation, they're tools for finance, commerce, and institutional capital flow. This reinforces the point we made earlier. Knowledge and strategic insight are more valuable than short-term hype. By understanding these developments, you position yourself to make smarter investment choices and stay ahead of the curve. In short, partnerships like Layer 0 and USDC integration on Cardano show that crypto is evolving into a more interconnected, functional, and attractive ecosystem for both retail and institutional players. They represent the next phase of growth, one that prioritizes real-world usability, security, and cross-chain collaboration. Charles Hoskinson emphasizes that while technology and potential are exciting, execution is what ultimately determines success in crypto markets. Let's break this down in simple terms. First, consider Bitcoin and DeFi. Bitcoin has always been the backbone of crypto. Its network is the most secure and widely adopted, but by itself, it cannot handle complex smart contracts or advanced DeFi applications. This is where companion layers like Cardano, Stacks, or other smart contract-enabled chains come in. They allow developers to build complex financial systems while leveraging Bitcoin's security. The combination of these networks increases total value locked, TVL, in DeFi and unlocks new possibilities for global financial innovation. Next, take XRP. While often misunderstood, XRP has strong real-world use cases, especially in cross-border payments and liquidity solutions. Hoskinson points out that XRP's interoperability with other chains like Cardano opens the door for DeFi applications that can handle hundreds of billions in value. Projects that successfully connect XRP with smart contracts can bring transparency, speed, and programmability to traditional financial processes. This isn't just theory, it's happening now, and the execution of these connections will define which networks thrive in the next few years. Hoskinson also stresses that execution matters more than potential. Every crypto project can talk about TPS, transactions per second, fancy features, or theoretical market caps. But those things alone do not guarantee adoption. What matters is building products that people actually use, creating strong governance, stability, reliability, and network effects that cannot be copied easily. A blockchain may boast fast speeds or low fees, but if the ecosystem lacks usability or real-world adoption, it won't survive long-term. Execution separates temporary hype from enduring success. Another point to understand is institutional influence. Institutions are increasingly entering DeFi, sometimes via Uniswap or other platforms, as Hoskinson mentions. While this brings liquidity and regulatory clarity, it also increases the stakes. If institutions dominate too heavily, they could steer development in ways that benefit themselves more than the broader community. That's why it's critical for investors to watch both adoption trends and technical execution, not just price action. One lesson here is that real-world impact drives value. Networks that provide tangible solutions, cross-border payments, secure DeFi lending, tokenization of real-world assets, are the ones that attract users, capital, and partners. This is why integrations like USDC on Cardano or cross-chain DeFi with XRP are game changers. They create utility, not just speculation. Investors who understand and follow these trends are in a better position to benefit over the long term. Finally, Hoskinson reminds us that the crypto industry is still building a brand new financial system. It's transparent, global, and trustless, but it also faces challenges: less capital than traditional markets, fewer standardized rules, and evolving infrastructure. To succeed, projects need execution, community, governance, and interoperability. Potential alone doesn't win in free markets, execution does. Let's talk about the current market sentiment. Crypto has been through a tough period. NFT crashes, meme coin hype, regulatory uncertainty, and stalled market cycles. Social media often amplifies negativity, making the industry feel worse than it really is. But while the micro picture looks bad, low prices, high frustration, the macro picture shows progress and innovation. Institutions are entering DeFi, major partnerships like Layer 0 and USDC integration are happening, and cross-chain interoperability is growing. This means the industry is structurally stronger even if sentiment is low. A key takeaway is that patience and perspective matter. Many investors feel burned out because they expected a big 2025 cycle that didn't fully materialize. Hoskinson reminds us that crypto cycles are not just about short-term price gains. They're about building infrastructure, attracting new users, and creating real-world utility. Projects that focus on execution, interoperability, and governance are the ones that will thrive when the next cycle begins. This is where strategic investors can gain an advantage. Another important point is the role of institutions and regulatory clarity. Banks and financial companies are now engaging with crypto, sometimes through DeFi platforms like Uniswap, and governments are gradually providing regulatory frameworks. While this increases legitimacy, it also means that the community must stay vigilant to ensure decentralization and user empowerment are not sacrificed. Non-custodial wallets, privacy features, and cross-chain integrations remain crucial for maintaining financial freedom. Hoskinson also emphasizes that execution beats potential. Many projects talk about high TPS, fancy features, or massive theoretical market caps, but without adoption, governance, and reliability, those features don't matter. Networks that deliver real-world utility, maintain community trust, and provide seamless cross-chain experiences are the ones that attract users and capital. For investors, this means paying attention to how projects operate, not just what they promise. So what should you do in the next 90 to 180 days? First, focus on long-term trends, not short-term price swings. Look for projects that integrate across ecosystems, offer real utility, and maintain strong communities. Second, stay informed about partnerships like Layer 0 and USDC on Cardano, and developments in Bitcoin and XRP ecosystems. Third, be mindful of risk. Market cycles will continue, and volatility is part of crypto. Diversification, strategic allocation, and understanding project fundamentals will help you navigate these periods confidently. Finally, remember that crypto is still a revolution in finance. We're building a global, transparent, trustless, and programmable financial system. It won't happen overnight, and challenges are inevitable. But with knowledge, patience, and strategic focus, you can participate in this evolution effectively. Channels like We Are Cosmic exist to give you clarity, reduce noise, and highlight actionable insights so you can make informed decisions.